Right, warm welcome to everybody. We're here today to learn a little bit more about Adamas Finance Asia, and we're delighted to be joined by Suresh Withana, who is not working directly for Adamas Finance Asia, but is the managing partner and I believe co-founder of Harmony Capital, who are the investment managers for Adamas Finance Asia. And I think probably the best person to explain what Adamas Finance Asia was set up to do and what it is now doing is you, Suresh.
Well, thank you, Andy. Yeah, as you said, Harmony Capital, which is a firm I co-founded and I'm the managing partner for, is the investment manager for Adamas Finance Asia. It's quoted on the AIM market of the London Stock Exchange. It is, by all accounts, the only actually pan-Asian investment company that is currently quoted on the AIM market that focuses on the small and medium enterprise sector of Asia. When it was originally set up, as you alluded to in your question, it was originally set up to focus entirely on China and essentially direct lending or private financing of companies in China, and that was some 5 years ago. Over the course of that period of time, the board determined that they wanted a slight change of focus and change of direction, and so Harmony Capital took over the management of the investment company in May of 2017. And concurrently with us taking over the management of the vehicle, we also changed by shareholder vote the investment policy for the company. So today, Adamas Finance Asia, or ADAM as I refer to it, which is the ticker, is permitted to invest anywhere in Asia. So it's a pan-Asian investment vehicle now, not China-focused. And secondly, invests essentially on an opportunistic basis across the small and medium enterprise sector, which is the SME sector.
That's probably Asia. Quite, well, history may look back and say it's quite a prescient move to remove a total focus on China, given the slowdown that's occurring in the economy now. But presumably you're not excluded from investing in China should you want to.
Absolutely not. And in fact, any pan-Asian vehicle, if it were to be truly pan-Asian, must have exposure to China because China is the world's second largest economy, the largest in Asia, the fastest growing in Asia, and obviously a significant influence over the direction of Asia. So we're not excluded from investing in China, quite the opposite actually.
But that would be quite a good point to just looking at the macroeconomics of the region. There are an enormous number of other economies, but to what extent, when you make your investment decisions, are you looking top-down at a country and perhaps assessing how the Chinese slowdown may be affecting them by way of contagion or even how some of the trade tariffs that are obviously unsettling quoted markets that might affect economies that you're looking at?
I mean, we approach the region on a bottom-up approach, actually. We like to focus first and foremost on the underlying companies that we're looking to invest in. Macro considerations are relevant to our investment process. However, our fundamental concern is really, who are we investing in? Who are we investing with? Who are the companies managed by? Who are their founders? What sectors do they operate in? And then build up from there. There is absolutely no doubt that if there is a slowdown in China, and I say if because as much as there may be a tariff war today, it could be turned off by one tweet tomorrow. The reality is that we don't know. But were there to be a significant slowdown in China, it will have an effect on Asia. There's no doubt about that. And we do factor that into our thinking whenever we look at a company, a specific company. But our approach is very bottom-up in terms of how we look at investment opportunities.
And what characteristics are you looking for in the bottom-up analysis in terms of perhaps some sectors are more appealing to you? Is it a case of looking also at more mature, smaller companies? Because it's a very generic phrase. It can range from startups to businesses that have happily thrived for 100 years.
Absolutely. And we're not a venture capital fund. We're not looking to finance companies or people with a great idea and a presentation. We are looking for companies in that SME space, as I mentioned, who demonstrate a few traits. One of them is companies that have a position within their industry that is secure in that they have a reason to exist. We're looking for companies first and foremost with good management teams and have significant investment from shareholders or founders, because again, we're not looking to buy somebody out of a business, we're looking to invest with them.
Yeah. People sharing the risk.
Exactly, alongside us. And we're also looking for companies that ideally are generating revenues and profits, typically have hard assets that we can potentially get some downside protection by securing our investment against those hard assets, whether that be land and buildings or other kind of assets. So those are the typical traits. Our flexible investment policy for Adam allows us to look at a range of companies, as you pointed out, all the way from startups to more mature companies. However, we find that in the SME space in Asia, there are an increasing number of companies that are quite mature, that have been operating for several years, that have been financed historically by their shareholders, their founders, friends and family, and now are starting to run out of steam and need additional capital to keep growing. However, the traditional sources of capital that one would be familiar with, let's say in Europe, such as banks or capital markets, are just simply not available to these small and medium enterprise companies.
Yeah, and is that lack of banking capital a situation that's worsening for SMEs? Is Basel II having an effect, or is it just the fact that financial institutions want to focus on larger groups, probably less complicated businesses to back?
I think it's a function of quite a few things. In Asia, since going back to the Asian crisis, which is going back quite a while back. And
sadly, I remember it, yes.
I do too. Banks did sort of restructure the way they looked at risk. And leading up to the global financial crisis in 2008 to 2010, Asian banks were actually very well positioned relative to their peers in Western Europe and the US, for example, because they had very little exposure to anything but corporate credit and real estate-backed lending, for example, in Asia. So the banks in Asia have learnt over the last 10 years and now have been forced by a number of governments to continue to support either state-owned enterprises or, as you said, larger companies that are blue-chip companies, companies that have established track records and are of critical size. And what that has meant is that the growth engine of the Asian region, which is the SME space, which are the small and medium-sized enterprises, have continued to lack capital from these, what shall we say, traditional sources, particularly the banking sector. And there is a staggering statistic, and that is that the OECD have estimated that there is a funding gap in the SME space in Asia alone of almost $2.7 trillion US. And that is essentially the difference between what the capital needs of these companies are relative to how much money is actually funneled to this sector from the banking sector across the region. So when you look at that number, it's almost irrelevant whether the gap is widening or narrowing. It's just a massive gap that exists today.
Yes, I was going to ask who you were in competition with to provide this finance, but it sounds like it's more of a hole. There's a clear need. And
it's a chasm.
You are the knight riding to the rescue, obviously on appropriate financial terms for your return on capital. And do you have a target IRR when you're looking at an investment, as well as the qualitative criteria you've mentioned?
As an investment manager, our primary objective is to manage risk in addition to making returns. And so our approach to returns is actually looking at things on a risk-adjusted basis. People are always fixated with what is your return target, and I could pick a number out of the air and say it's 15% or it's 20%.
But if you have one bankruptcy in the portfolio, that
tends
to bring the average down.
Absolutely. And equally, when we're looking at a situation, bearing in mind we're a pan-Asian company, when we're looking at a situation, let's say in a developed economy in Asia, such as Singapore as an example, or Japan or Australia, versus, let's say, a developing economy in Asia, which is, let's say, a country like Indonesia or Thailand, one can't look at risk the same way, because the inherent systemic risks as well as the idiosyncratic risks of a specific investment, could be quite different depending on which country you're operating in. So therefore, a 15% return, just to pick an arbitrary number, in Australia could be very attractive relative to a 15% return in a country like Thailand. So I'm not trying to evade your question. I'm just saying that when we look at return thresholds, we always look at what kind of environment we're investing in, i.e. the country, what kind of structure we're using, and what kind of downside protection there is. I'd say by and large, we do tend to gravitate towards deals that generate at least a gross internal rate of return of 15% or above. But again, we're not dogmatic about that.
And this again relates back to the macro factors, where we can presumably also include looking at the politics and the stability
Absolutely.
of a country in which you're investing in.
Yes, absolutely.
So how much change have you had to make? I believe would you probably 16, 17 months as the investment manager now in inheriting a portfolio of essentially unquoted assets, I presume. It can't have been easy to make changes as quickly as you perhaps would have liked, but
well, it's kept life interesting. I can say that for the team at Harmony Capital, and Harmony Capital is a team. We are a team of people spread across Asia, and our offices in Hong Kong, Singapore, and also here in London. The team's
how many people out of interest?
In total, we have 9 people who are dedicated.
They must
to
be busy
Harmony.
covering that $2.6 trillion gap.
Yes.
But,
we're all very busy. It leads to a lot of interesting times. But to focus on the original portfolio you mentioned, as I said, it was originally focused and entirely invested in China. So as a result of those decisions that were made historically, we spent pretty much the last 18 months restructuring that existing portfolio or disposing of that portfolio. And we have announced, or our vehicle has announced, that we've restructured or disposed of at least 80% of our legacy portfolio, as we like to call it. But that is now behind us. I mean, 80% is a big number. We've taken out most of the majority of the portfolio. And really our current focus and the team's focus now is looking for new investment opportunities that match the new investment policy. The board has directed us to continue to focus on diversifying our investment exposure across Asia. They have also directed us, as we have announced previously, to focus on looking for income-generating assets or income-generating investments with capital gain potential. And that is exactly what we're doing. We've been very busy in the last 6 months in particular, building a pipeline of investment opportunities that span Asia and are solely not focused on China, and secondly have those characteristics of income generation capability as well as capital gain potential.
And the phrase income generators again tends to imply a slightly more mature form of SME that you're investing in, that is profitable or has the cash flow to pay income, which probably leads quite neatly onto you have made one new investment, Doc,
yes,
which I'm sure you can tell us a little bit more about in terms of the fundamental attractions. But if I remember correctly, that was a convertible bond paying a 8% coupon, 8% coupon, which is hopefully allied with the potential for capital gains as well as a business.
Indeed. I mean, DocDoc's a very interesting company because it has been around for about 4 years now, almost going into its 5th year. It's a business that is unique in many respects because it is a patient empowerment company. And when I say that, it always raises an eyebrow, but I know this company relatively well now, given I'm also on the board of the company as a nominee for Adamas Finance Asia. The business basically brings together the best healthcare outcomes possible across Asia for patients that are looking for it, because as the founder pointed out to me, healthcare is one of the only industries left in the world where there is a high degree of opacity between what you pay for and what you get. And in Asia, private healthcare is a burgeoning industry. And yet the same applies, which is you don't really know what you're paying for when it comes to your private healthcare. And DocDoc has a register now of I think over 20,000 doctors across Asia, over 100 hospitals, over 600 clinics that are all referenced through a database and an artificial intelligence engine, which enables patients who use that service to get the best orthopedic surgeon or the best heart surgeon recommended to them, or at least a choice of 2 or 3 of the best in dealing with the ailment that they need cured. So it's a very unique business.
How international is that network?
It's solely focused on Asia, so it's really only addressing Asian healthcare needs, which is what is very attractive to us, because healthcare is a very significant theme in Asia and its development as far as we're concerned. So when we saw DocDoc looking to raise money, we structured and anchored actually and led the financing, which is the convertible bond you referred to. It has a number of the elements that we like, as you pointed out: income, a capital gain. Hopefully this company will eventually go public one day, or maybe be sold to a strategic. There are a number of exit options, so that hopefully will be captured through the convertible bond. And another aspect of our investment style is to be active, and in this case, by virtue of having a board representative, which is myself, for good or for bad, enables us to engage with the company on a monthly basis, actually, and really get a sense of what's going on and to learn from that as well. So it's a very exciting investment. We're very happy with it.
And to what extent, if any, do you look at investment and assess the exit potential? If we're presumably, again, mostly investing into unlisted businesses, you just mentioned an IPO may be one route going onto public markets to provide liquidity, or presumably you're also assessing trade sale potential with some of these businesses once they've got the petrol in the tank to help them grow a little bit quicker and increase the value.
Well, if any of my team was sitting here, they would tell you that a very fundamental part of our investment process is understanding our exit and having an exit analysis, which we always present to our investment committee. It is a very important part of our analysis, which is how do we return or recover the investment capital that we deploy into these companies. Initial public offerings or an IPO are only one route for us to have capital returned. As you said, trade sales is another. The third is also we look for self-liquidating investments, being companies that can actually essentially repay us over time if we were to structure something as a credit-like instrument. Sometimes we attach our investment to an event. So, for example, the completion of an asset that is being built with our financing, which then gets sold, we get the first rights of repayment out of the proceeds from that asset disposal, for example. So there's a number of mechanisms that we use and look out for in terms of return of capital, because it's great to invest, and as I always tell my team, it's easy to write a check. It's always, the hard part is getting your money back and then making money on the money you've deployed. So exit analysis is very important to us, and we always look for more than one route to exit an investment and try to make that determination before we make the investment.
And how much would you say that the doc structure that we just talked about is a template for future investments, or do you have to adapt to each situation as it comes in front of you?
I would say that generically investing in a company like DocDoc through a convertible bond, which has an income component, a convertible bond that has a capital gain component to it, long-dated optionality basically, is quite representative of the things that we're looking to do. If I was to look at our pipeline today, a number of our opportunities are actually convertible bond structures that we've negotiated, or debt structures with warrants, for example, to capture upside. But they all have that commonality, which is income and capital gain. DocDoc as a company is in healthcare. We're sector agnostic, so it doesn't mean that all of our companies are going to be in the healthcare space. But in terms of structure, I would say it's fairly representative of what we're looking to do.
It is a sector where disposable income from the ever wealthier middle classes is presumably going to be directed. So.
Absolutely. I mean, we've found that, and it doesn't take a genius to figure it out. You've got an aspirational middle class, which is the largest in the world. It's growing. And so therefore, think about what anyone who is becoming, shall we say, better positioned in life wants. They want a better education for their children. So education is a sector that we're looking at. They want better education, better healthcare for themselves and their children and their family. Healthcare is a space that we're looking for. They have more disposable income, so they're spending. So therefore, consumer-driven sectors are, again, where we see a lot of opportunities.
Ever bigger television screens, so we've all seen this.
Better clothes, better televisions, nicer cars, exactly. Exactly.
And as much as you can you tell us a little bit more about the presumably burgeoning pipeline that you've already referred to, and how close some of the opportunities are, and indeed how capable you are of financing and investing in those opportunities, having raised or liquidated a reasonably large amount, presumably 3/4 or more of the portfolio that you inherited.
Well, let me answer it in stages, perhaps. So in terms of the pipeline itself, pipelines are what they are. They change on a daily basis. Deals come in, deals come out. We have a very regimental and very detailed assessment process internally. So I would say that the success rate for deals that we see in terms of them actually getting into our pipeline post our initial screening process is less than 1%, maybe 2%. So we see a lot of deals which we say no to. So the deals we have today in our pipeline probably reflect the better components of the opportunities we've seen thus far. They range across the region, as I mentioned earlier, from countries like Australia to Japan, to Singapore, Thailand, Indonesia, Philippines, and China, as well as in India. We're seeing some opportunities there. So they're all in our pipeline currently. In terms of sector, they're spread across the sector from healthcare to consumer. We have a real estate transaction that we're looking at currently, and a variety of other types of sectors that we are looking at. In terms of where they are relative to perhaps us making an investment, given our internal process is again quite extensive. We do a lot of due diligence on these companies and opportunities before we take the opportunity to our board. The board of Adamas Finance Asia is our investment committee. I would say that some of the transactions are in deep due diligence currently, while others are at the early stage of our due diligence process. In terms of how we would fund and finance these transactions, you're right, we have capital on our balance sheet. That's a matter of public record. And over time, as our pipeline starts to grow further, there is a possibility that at some point we will want to start gathering more capital from the public markets in order to fund that pipeline.
And presumably a part of that will be the reputation that Harmony Capital has built up prior to taking on this mandate. How different, or indeed how similar, is what you're doing for Adam compared to the previous years of Harmony's management of investment?
Well, I co-founded Harmony Capital in 2005, so it's been around for a while. And our first fund was actually a private fund, meaning that it was not publicly listed like Adamas Finance Asia is, and it was funded by a number of limited partners or investors, including pension funds from the US and some family offices from Asia and Europe, and some other institutional investors. Ironically, that fund's mandate is virtually identical to what we do today. It was a Pan-Asian, what we call special situations vehicle. Its mandate was to invest in small and medium size enterprises.
We've heard that before then.
Exactly.
Yeah.
And so in a sense, it should be no surprise that the investment policy we recommended actually to the board for Adamas Finance Asia when we took over was very similar to what we were most used to doing before. So it is very similar. The fund was a private fund. It reached the end of its life, which was a 10-year fund, which is typical of private funds. And so now we are very privileged to be managing this vehicle with a very similar mandate.
And would that be an exclusive mandate, or is Harmony running assets for anyone else other than Adam?
At the moment, no. It's exclusively Adam, which is our client.
Okay, and perhaps we might just finish up by, as you say, looking at what is a unique offering of a share quoted on the London Stock Exchange on AIM. It's going to be quite difficult for private investors or indeed institutions in the UK to go and do the extent of due diligence that you and your team have clearly done. But looking at your recent results, declared net asset value that is almost twice of the current share price, either there's some horrible risk that we're not aware of, or is it just a situation that investors don't yet know enough about what Harmony are doing and the opportunity that exists there, or is it a function of illiquidity of the shares, perhaps?
I think it's a combination of a few factors. First and foremost, I think it is that the market doesn't know what we're doing. I don't think, even though Adamas Finance Asia has been listed or quoted for several years, I don't think the market really appreciates the change, the fundamental change in the nature of the underlying portfolio, the investment policy, the investment manager, and its new direction. And I'm hoping that conversations like this will help educate people about the opportunity. And because it's not a very well-known story, it is also an illiquid investment, currently a liquid shareholder base. And so therefore, as you quite rightly pointed out, our current share price is not reflective at all of our, what I call our restructured NAV, post all the work that we've been doing that we've discussed. So I think currently we're at, I think, almost a 50% discount to our recently announced unaudited NAV. And I think that's an opportunity for people in of itself, just the fact that it is a significant discount, the share price today. But beyond that, the board has also made it clear that as soon as practical, they wish to start paying a dividend to shareholders once the restructured, the repositioned new portfolio starts to generate the
portfolio
income.
that's bringing in income to the
Exactly. And so, to me, I see an opportunity for people to invest in a stock that not only is at an attractive discount, but over time will start paying an income component from a diversified Asian portfolio of assets. And as I've said, perhaps flippantly in the past to other people, unless you want to get on a plane yourself and fly to Asia and find these opportunities yourself and structure them yourself, one of the easier ways to get that exposure into your portfolio would be to look at our stock.
Yeah. Well, I think on that very positive summary, we will thank you for your time and wish you the best of luck in your disposals, your investments, and all other corporate matters. And for those of you who do want to see a more third-party view of Adam and its prospects, there is, of course, a recent note written by Equity Development that goes into a bit more detail on what Suresh has just introduced to us. Thank you.
Thank you, Andy.